stop for a moment and slow everything down, because what you're about to hear is not noise, not hype, and not another fast headline meant to distract you for 10 seconds before the next story appears. This is information that forces you to rethink how power truly works, how money really moves, and why the system you were told to trust has never been as honest as it claimed to be. For years, people who questioned the financial system were mocked, ignored, and pushed to the sidelines, while major media outlets assured everyone that everything was stable, fair, and under control. They laughed at concerns about precious metals, dismissed silver as a hobby item, and described gold as an outdated relic with no real role in a modern economy. We were told that central banks had perfected the system, that markets were free and transparent, and that prices reflected nothing more than clean supply and demand. We were assured that no powerful group was secretly positioning itself, and that no elite network had any real interest in owning hard assets like silver or gold. At Alex Carter Reports, we have always challenged that story, not because we enjoy controversy, but because the math, the incentives, and the behavior of the powerful never lined up with the official narrative. What we are sharing today is not speculation, not theory, and not a guess based on patterns, but something far more uncomfortable for the people at the top. This time, the evidence did not come from a whistleblower stepping forward or from classified files smuggled out of a government office under risk of prison. It came from digital records left behind, sitting quietly in archives that were never meant to be examined by the public. The date matters here, because timing is everything in markets and in power shifts. It is Wednesday, February 11th, 2026, and while most of the world is distracted by geopolitical tension, oil price swings, and endless celebrity drama, something far more important has surfaced beneath the surface. A massive data release connected to the Epstein case has spread through encrypted networks, and most people are only looking at the most sensational parts of it. They are focused on flight logs, names, scandals, and who visited which island, and yes, accountability matters and justice matters. But buried deep inside those same data files is a financial story that the mainstream press has almost completely ignored, because it exposes something far more dangerous than personal scandals. It reveals how money was actually being positioned behind closed doors by people who understood the system far better than they ever let on in public. What these records show is that Jeffrey Epstein and Ghislaine Maxwell were not only running a blackmail operation, but were also deeply involved in managing wealth for powerful individuals. They were allocating capital, placing long-term bets, and quietly preparing for a future that contradicts everything the public was told. When analysts at Alex Carter Reports began reviewing recovered communications, a pattern quickly became impossible to ignore. There were detailed discussions about silver, about physical delivery, and about weaknesses in the global financial structure that most investors were never supposed to notice. One set of emails, dating back to the early 2010s, stands out because of its timing and its clarity. This was right after the 2008 financial crisis, during the period when trust in banks was already shaken and when silver last surged toward $50 an ounce. At that moment, the public was being told the system had healed, that the crash was behind us, and that precious metals were no longer relevant. Behind closed doors, however, the tone could not have been more different. In a private exchange dated November 2nd, 2011, a senior European banking figure, referred to only as Bernard, offered direct advice on portfolio strategy. This was not casual conversation, not guesswork, and not marketing language designed for television viewers. This was how real decision makers spoke when they believed no one else was listening, when there were no cameras, no interviews, and no need to protect a public image. Bernard did not suggest government bonds, stock indexes, or faith in the strength of the dollar. Instead, he focused on silver, and more specifically, on something most retail investors never consider. He explained that a true squeeze becomes possible when someone demands full physical delivery of futures contracts rather than settling for cash. This single idea changes everything because it exposes a weakness at the heart of the modern market structure. The system depends on the assumption that most participants will never ask for the real metal, only paper claims. Bernard made it clear that the silver market was built on leverage, with far more paper ounces traded than physical ounces available. If even one major player insisted on taking delivery of everything they owned, the structure would begin to crack. This was not fear or paranoia, but a cold assessment based on data, ratios, and the mechanics of futures markets. It showed that the people at the top understood the game years before the public ever suspected it existed. At Alex Carter Reports, we see this as a critical moment of truth. The elites were not ignoring silver, laughing at it, or dismissing it as outdated, but quietly studying how it could break the system they publicly defended. They knew the numbers did not add up. They knew that if confidence ever shifted from paper promises to physical delivery, the price could move violently and quickly. What makes this even more revealing is that Bernard went beyond theory and discussed price levels openly. At a time when the media was declaring the silver bubble dead and urging investors to move on, private conversations told a very different story. Silver, according to these internal estimates, was not overpriced, but deeply undervalued once inflation was properly accounted for. This was the world as seen from private jets and closed conference rooms, not from nightly news broadcasts. The takeaway from this first phase is simple but unsettling. The same people who told the public not to worry were already planning for a scenario where the system itself would fail. They were positioning early, quietly, and methodically, while confidence and complacency kept everyone else distracted. And this is only the beginning of what these records reveal. Because once you understand what they believed back then, the events unfolding today start to make terrifying sense. Once you accept that the people closest to power understood the weakness of the silver market years ago, the next question becomes unavoidable. Did they just talk about it, or did they act on it in a serious and deliberate way that could not be explained away as coincidence? The documents reviewed by Alex Carter reports answer that question clearly, and the answer is far more unsettling than most people are prepared to hear. These were not idle discussions meant to impress friends or signal intelligence. The leaked trading records attached to those private communications show large coordinated actions that line up perfectly with the strategy Bernard described. This was not paper speculation, and it was not short-term trading meant to capture quick profits. What we see instead is long-term positioning designed to gain control over real supply, not just price movement on a screen. Ghislaine Maxwell, acting on behalf of Epstein-linked entities, executed massive purchases that cannot be dismissed as normal portfolio diversification. The numbers stand out immediately because of their size and their focus. Millions of units were accumulated in specific silver-related assets, with a clear emphasis on companies tied directly to physical production. One name appears repeatedly in these records, and that name is First Majestic Silver. This is not random, and it is not accidental. First Majestic was singled out because its leadership openly challenged the pricing structure of the silver market. Its chief executive publicly questioned paper suppression and threatened to withhold supply if prices did not reflect reality. That stance made the company unique in an industry where most executives avoided confrontation with major banks. For anyone planning a future squeeze, control over producers willing to resist the system would be invaluable. This explains why Epstein-linked accounts did not focus on silver exchange-traded funds or abstract derivatives. They were not interested in claims or promises. They wanted leverage over the source of metal itself, both through mining companies and through physical delivery. This approach required patience, capital, and a belief that the system would eventually crack under its own weight. What this destroys completely and permanently is the idea that silver advocates are fringe thinkers detached from reality. The most connected individuals on the planet were acting on the same conclusions, just without telling anyone. These were people with access to intelligence, financial data, and private economic assessments far beyond what the public ever sees. And they were quietly betting against the dollar, against central banks, and against the stability of the existing monetary order. At Alex Carter reports, we believe this is where motive becomes just as important as action. Why would someone like Epstein, who already possessed influence, leverage, and blackmail material, feel the need to secure silver at scale? The answer lies in the nature of power itself, which is often misunderstood. Power is not just about secrets or influence over people. True power is independence from systems that can turn against you overnight. Fiat money systems, by design, give governments and banks ultimate control over wealth held within them. Accounts can be frozen, transactions blocked, and assets seized with the stroke of a pen. Physical metal does not obey those rules in the same way. If you hold it directly, outside the system, you are no longer fully dependent on institutions that can change the rules without warning. The emails make it clear that this understanding was central to the strategy being discussed. Epstein and his network saw the debt growth, the derivatives exposure, and the long-term instability baked into the system. They knew that mathematically, it could not continue forever. The final piece of Bernard's message adds even more weight to this conclusion. He predicted that the gold to silver ratio would eventually fall below 20. That statement is not casual, and it is not optimistic speculation. It implies a dramatic repricing of silver relative to gold. At current ratios near 90, such a move would require silver to outperform gold by several multiples. If gold were to rise significantly, silver would rise even more aggressively under that scenario. These were not numbers discussed on financial television at the time. They were numbers whispered in private, where honesty mattered more than public confidence. The implication is staggering when you place it in today's context. If silver was undervalued at $150 in 2011 on an inflation-adjusted basis, then today's value would be far higher. Trillions of dollars have been created since then, national debt has exploded, and purchasing power has continued to erode. The math does not move backward. This brings us to a disturbing realization. If Epstein and Maxwell were accumulating metal and mining exposure more than a decade ago, that metal did not disappear. It did not return to the market, and it was not sold back to relieve shortages. It was locked away, placed in trusts, vaults, and structures designed to keep it out of circulation. In other words, they front-ran the public, but they were too early. They understood the outcome, but underestimated how long manipulation could delay it. The suppression machine proved stronger and more persistent than they expected. Prices were held down, confidence was shaken, and interest faded among everyday investors. But time did not eliminate the imbalance, it only made it worse. Supply tightened quietly, inventories thinned, and industrial demand continued to rise. Now, after years of delay, the system is showing visible cracks that can no longer be hidden with paper trades. And this is where the story shifts from history to breaking reality. The squeeze Bernard described is no longer theoretical. It is no longer something planned by secretive elites alone. It is happening through nations, through policy decisions, and through actions taken at a scale no individual could match. The question is no longer whether silver is important, but who will be allowed to access it. Because when the system feels threatened, it does not admit failure. It changes the rules. And that brings us directly to what is unfolding right now in the East, where access to physical silver is being restricted by force of policy. What Epstein anticipated as a market event has become a government decision. This is the point where past warnings meet present consequences. And it is here that the story becomes impossible to ignore, because the doors are no longer just closing quietly. They are being locked in plain sight. When markets begin to fail, the first sign is not always a price spike, and it is rarely an honest admission from those in charge. The first sign is usually a rule change, quietly posted, written in technical language, and designed to look boring enough that most people never read it. That is exactly what happened in Shanghai, and it is one of the most important financial developments of this decade. While much of the world was focused on old emails and historic revelations, a decision was made that affects the present and the future. The Shanghai Futures Exchange, the largest physical silver market on the planet, implemented a new delivery rule that fundamentally alters who can access metal. This was not speculation, a rumor, or a leak. It was an official policy update, published openly, yet barely discussed in Western financial media. Starting February 28th, the exchange declared that only participants with specific government-approved hedging quotas would receive silver delivery. For everyone else, the result is simple and brutal: zero allocation. This does not mean delayed delivery or partial fulfillment. It means nothing at all. If you are a private investor, a family office, or anyone outside the state-approved industrial circle, you are forced to settle in cash. You paid for metal, but you will receive currency instead. This is not how a free market behaves. In a functioning market, shortages are resolved through higher prices, not bans. But China is no longer pretending that silver is just another commodity. It is treating it as a strategic resource critical to national survival. Solar manufacturing, electric vehicles, defense systems, and advanced electronics all depend on steady silver supply. Allowing public investors to take delivery would risk disrupting those supply chains. So instead of letting the price rise and signal scarcity, the state chose rationing. Every ounce is being reserved for industries deemed essential. At Alex Carter Reports, we see this as an open admission of shortage. You do not ration something that is abundant. You do not ban delivery of something that exists in excess. You only take these steps when inventories are dangerously low. This single policy change confirms what private emails hinted at years ago. The paper market wrote, "Checks it can no longer cash." For decades, exchanges relied on the assumption that most contracts would never result in physical delivery. Shanghai just signaled that this assumption has failed. Now imagine the psychological impact of this decision inside China itself. Wealthy individuals, business owners, and savers see the vault doors closing. They understand that if silver cannot be obtained through official channels, it must be sourced elsewhere. This triggers panic, not calm. Black markets thrive when governments restrict access to real assets. Jewelry demand spikes, premiums explode, and smuggling becomes profitable. Early reports already suggest street-level prices far above official spot values. When people are told they cannot have something, demand rarely disappears. Instead, it shifts underground and becomes more intense. This dynamic is not limited to China. Once global traders realize that the largest physical market cannot deliver, confidence in paper pricing erodes everywhere. The number on a screen stops representing a real, obtainable product. A posted price of $70 or $80 becomes meaningless if no metal is available at that level. In effect, the price becomes theoretical. While China is locking down its supply, another massive force has entered the picture from a different direction. India is not restricting access. India is buying aggressively, openly, and at a scale that defies traditional supply models. Recent data shows that Indian silver ETFs added 13.5 million ounces in January 2026 alone. That is roughly 420 tons of physical metal removed from the global market in a single month. And this does not include jewelry, industrial use, or informal cash markets. This follows an already record-setting December 2025, when another 23 million ounces were accumulated. In just 60 days, more than 36 million ounces disappeared into Indian vaults. To put this into perspective, global annual silver mining produces around 800 million ounces. India absorbed nearly 5% of that total in 2 months, just through investment demand. At this pace, annualized buying would exceed 200 million ounces in 2026. That alone would consume more than a quarter of the world's supply. At Alex Carter Reports, we see this as the real whale Bernard never anticipated. Not a billionaire, but a nation acting in unison. Indian investors understand currency risk deeply because they have lived through it. They do not fear price drops the way Western investors do. When silver falls, they see opportunity, not danger. They treat it as a sale on something they already trust. Unlike paper products, Indian silver ETFs are required to hold physical metal. Every purchase removes real bars from global vaults. Each transaction drains supply from London, New York, and Zurich. The arbitrage pulling silver from west to east accelerates with every price dip. Now the market faces a violent tug of war. China is hoarding and rationing to protect industry. India is accumulating and consuming to protect wealth. Both forces pull metal out of circulation. In the middle sits the paper market, still quoting prices that assume abundance. This imbalance cannot last. One side restricts supply, the other expands demand, and the price mechanism is frozen. Something must break. Western banks believed suppressing price would protect the system. Instead, it subsidized Eastern accumulation. Lower prices made it easier for India to buy more, faster. The shelves were cleared while confidence remained artificially low. Bernard believed it would take one powerful individual to force delivery. He was wrong. It took population scale behavior combined with state policy. The squeeze is no longer a theory discussed in private emails. It is playing out in real time through national actions. And the consequences of this shift are only beginning to surface. When pressure builds inside a closed system, it does not release slowly or politely, and it does not ask for permission before changing everything. It breaks at the weakest point. And in financial markets, that point is always the promise that paper can stand in for reality forever. What we are watching now is the slow collapse of that promise, not through headlines, but through behavior. Exchanges are rewriting rules, governments are choosing winners, and entire populations are acting in ways that expose the truth beneath the pricing screens. At Alex Carter Reports, we want to be very clear about what this means, because confusion is exactly what protects a broken system. The silver price you see quoted today is no longer a true market price in the classic sense. It is a reference number for a product that fewer and fewer people can actually obtain. When delivery becomes restricted, delayed, or denied, the quoted price becomes disconnected from physical reality. This is how markets die quietly before they explode loudly. The number still updates, charts still move, and analysts still debate small fluctuations, while the real asset vanishes behind locked doors. This is why the focus on short-term price swings misses the point entirely. A drop from 80 to 70 does not signal weakness when supply is disappearing and demand is accelerating. It signals stress, distortion, and desperation from entities trying to hold control just a little longer. History is full of examples where price suppression backfired in exactly this way. In the 1970s, gold experienced violent corrections that convinced the public the move was over. Each correction was followed by a far larger surge once confidence in paper claims finally broke. Silver today sits in a similar position, but the scale is far larger and the system far more leveraged. The cup and handle structure that institutional analysts quietly track has been forming for over 4 decades. That kind of formation does not resolve with a mild outcome. When patterns take that long to build, they release energy in ways that feel impossible until they happen. Conservative projections point to multiples, not percentages. Adjusted for inflation, the previous highs already imply numbers that sound unrealistic to anyone anchored to today's price. But markets do not care what sounds reasonable. They care about clearing imbalances. When China restricts delivery and India absorbs supply, the imbalance becomes global and unavoidable. Western markets cannot remain insulated when physical metal is drained from shared vaults. London and New York are connected to Shanghai and Mumbai by supply chains, not politics. When one pipe runs dry, pressure increases everywhere else. This is why delays are lengthening and premiums are rising even before official shortages are admitted. Dealers begin to hedge risk by quoting longer delivery times and higher margins. At first, it feels temporary, then it becomes normal. Eventually, availability itself becomes the question, not price. This is the stage where force majeure notices appear and settlement rules quietly change. The pattern is always the same because the incentives never change. No exchange wants to admit it cannot deliver. No bank wants to be the first to say the metal is gone. So rules are adjusted, definitions are altered, and access is limited. China's zero allocation policy is not an isolated case. It is a preview. It shows how quickly a government can decide that public access to a strategic asset is no longer acceptable. It also shows how fast confidence can evaporate once that decision is made. Ask yourself what happens when similar logic is applied elsewhere. Ask how long it would take for another major market to follow the same path once inventories tighten further. Do not assume advance notice. Do not assume transparency. Policy changes rarely arrive with warnings. They arrive after the decision has already been made. This is why timing matters more than prediction. The elites understood this years ago, which is why they positioned early and quietly. They did not wait for confirmation from headlines. They acted when metal was available and rules were still stable. Today, the public is only beginning to see the consequences of those early moves. The question now is not whether the system is stressed, but how it resolves that stress. There are only two outcomes. Either the price is allowed to rise dramatically to ration demand, or access is restricted to protect supply. China has already chosen restriction. India has chosen accumulation. Neither choice supports a stable, low-price environment. Both choices accelerate the same outcome. When the paper market finally fails to reconcile with physical reality, repricing will not be gentle. It will not wait for consensus. It will happen when trust breaks, not when charts look comfortable. That moment often arrives suddenly, after long periods of frustration and disbelief. At Alex Carter Reports, we believe the most dangerous mistake is assuming there will be time to react. History shows that access disappears before panic fully registers. One day you can buy. The next day, you are told to accept cash instead. This is not fear-mongering. It is pattern recognition. The Epstein emails mattered not because of who wrote them, but because they revealed awareness of a structural flaw. That flaw has not been fixed. It has been stretched, patched, and delayed. Now it is being exposed through policy, demand, and scarcity. Silver is no longer just an investment debate. It has become a strategic issue, a political issue, and a trust issue. When trust in paper erodes, people reach for what cannot be printed. That behavior is already visible across continents. The final question is not about price targets or charts. It is about positioning before choice is removed. Because when markets close, they do not reopen on better terms for the public. They reopen with new rules that favor those already inside. This is the lesson hidden beneath the data, the emails, and the policies. Power does not announce itself. It prepares quietly, then acts decisively. And right now, the actions speak louder than any price quote ever could.